Hello students, am I audible? Hi, good evening. Hello, good evening. Am I audible?
Yes, madam.
Okay, we can start now. So this is just a reminder. So last week I think you can remember I explained about the gain on realization of assets and liabilities. So at that time we discussed about capital gain tax and all other things. In addition to that, I explained some special provision, that is involuntary realization of asset with replacement. So at that time I said that I will do this provision again with an example. So now I will start it from from here. So this is the involuntary realization. So as I explained last week, involuntary means it is so realization may happen in several ways. It is not only the sale, it can be a sale, destroy, anything can happen. So we have specific definitions for realization. I will share these slides. I have already shared actually today I did it, so you may receive it today or tomorrow. So you can see it. So in this presentation slides, I'll explain what are the situations that we can consider as realization. So this is involuntary realization. So involuntary realizations means normally realization can happen with voluntary. That means if it is a sale, it is a voluntary situation. That means if I want to sell my assets, it is a voluntary sale, voluntary realization. But sometimes without our wish, without our requirement, we have to do something. That means it is by other party realize our assets, other party do some actions, take some actions. Due to that action, it will be a realization. So we call it involuntary realization. Without our wish, something will happen, realization will happen. So what are the situations? This can be happen in the with the government acquisition of our lands or buildings. So for an example, if we have a land in city area, if government wants to expand the roads, then they request our lands. So they will pay some compensation for that land, but without our wish, without our requirement, we have to realize that asset. So we call it realization, involuntary realization. But if after that involuntary realization, if we are doing it with the replacement means, suppose we have a land, government acquire it. Acquire means government take our land and they pay some compensation, but using that compensation amount we can replace the same asset. If it is a land, we can purchase another land in different area using that compensation value. So we call it replacement. So if that kind of situations are happen, we can apply section 47. Then according to that section 47, we have to identify what is the amount we have to consider for taxation. Because if it is a realization, definitely there will be a profit or loss. Same as normal realization, in the involuntary realization situations also, we have that kind of gain or loss. So we have to identify that gain or loss, but there are some specific provisions. So we can read this section, then you can understand somewhat. After that we will do it with the example. So if a person involuntarily realizes an asset and acquires a replacement asset of the same type within 6 months before, or 1 year after. That means if that realization happens today, prior to 6 months before this realization, no, 1 year after this realization, if we replaced some asset without considering total amount as the income, we have to apply some concessions are there. So according to that concession, we have to consider the value to be considered for income tax purposes. So for that purpose, we have to replace that asset before 6 months, so after 1 year of that realization. And there should be elects in writing. That means that person should mention that he is going to apply section 47. Then the person is treated as realizing an amount. So realization, if there is a situation like this kind of involuntary realization, then what is the realization value? Realization value will be the net cost of original asset. If it is a land, so we have to decide what is the net cost of that asset. So what is the meaning of the net cost? In that, we have a specific definition for the net cost. So it says, if we are going to realize a depreciable asset, then written down value is the net cost. But if it is other than depreciable asset, normal cost is the net cost. Normal cost, if we have some expenditure, if we receive some amount, we can remove that part. So we have a definition in that. You can refer the definition for net cost. So net cost of the original asset plus any excess of proceeds over replacement asset cost. That means we are receiving some compensation for that acquisition by the government, and using that amount, if we are going to replace that asset, then what is the value we are going to pay for the replacement? If that value, if the compensation exceeds that replacement, so we have to consider that amount. Then what is the cost of the replacement asset? We need that one also. So if we are going to replace another new asset for that acquired asset, the cost of the replacement asset equals net cost of original asset plus any excess of replacement asset cost over proceeds. So these are the two items that we have to consider for realization and for cost. So now we can move to the, and in addition to that, there is a specific provision under section 47. It says the Commissioner General may define when replacing one security with another due to merge, due to demerge or restructuring is considered as involuntary realization. That means if we are going to do this kind of involuntary realizations by merging, demerging or restructuring, then that kind of situations should be defined by the Commissioner General. So up to now, Commissioner General has not defined this kind of situations as a involuntary realization. So now I am moving to the example, because without this example, I think it is difficult for you to understand what is the involuntary realization value we have to consider for income tax purposes. So in year 2015, Mr. Pereira purchased a land and building and used as stores of the business. That means he used this land and building for the business purpose. During the year means this year, this has been acquired by the government for highway development project. So now you can understand what are the situations that government can acquire this kind of lands or buildings, and we call it involuntary realization because it is not with the willing of Mr. Pereira, but the government requires that land. The net cost of the land and building as at 1st of April 2025, that means beginning of the year of assessment, was 2 million and 6 million. That means you have given net cost of the land and building, that was 2 million and 6 million respectively. The government compensation received for land is 14 million and for building that is 5 million. So worth of this land is 2 million and the building 6 million, that is net cost. So net cost means if it is a depreciable asset, that is written down value. So here we can identify this building as a depreciable asset because this building is used for the business purpose. Therefore, it is a depreciable asset. Then the compensation is 14 million for land and 5 million for building. New land and buildings was purchased 2 months before this compulsory acquisition. So that is within the specified time period. So to be considered this as an involuntary realization, that replacement should be done before 3 months or after 1 year of this realization. So this replacement was happened 2 months before the realization. Therefore, we can consider this replacement as under involuntary realization. So now we can move to the example. Land and building acquired by the government. So this is just this is the example. Asset is land. Net cost of the land is 2 million. So after this compulsory acquisition, compensation received from the government is 14 million. Using that 14 million, this person replaced new land worth of 12 million. Then the building, net cost of the building is 6 million. Then the compensation received for that building is 5 million. And the cost of the new asset, that means he purchased the building, he replaced the building acquired by the government, that the value is 8 million. So now we are going to calculate the realization value of this inventory realization. Land consideration, that means to calculation of the gain or loss, we need two components. One is consideration or realization value. The next one is the cost. So the difference between realization value and the cost is the gain or a loss. So under section 47, under involuntary realization, consideration or realization value equals net cost plus excess of compensation, not the normal value. We do not consider only the compensation value as the realization value. We consider different values. If we consider the consideration as the total amount received as compensation, that is 14 million. So since this is a compulsory realization, we do not consider the actual compensation value as the land consideration. We have a different formula to consider that realized value. So this is the formula. Formula is consideration or realization value equals net cost plus excess of compensation. Then net cost, that is the value 2 million, you have already given it, 2 million plus excess of compensation. What is the excess of compensation? Excess of compensation, we have another different long wordings in the act, but this is just a summary. So you can refer the act to get that full wordings. It says excess of compensation over the cost of new asset. That means if we have excess value after replacement of that asset, that is the excess of compensation. Here compensation value is 14 million. Using that value, he replaced a land by paying 12 million. That means 2 million is the excess of compensation. So for the consideration value, we consider net cost plus that excess of compensation, not the total compensation value we received. Then the value is 4 million. This is the realization value or the consideration. To calculate gain or a loss, what we have to do? We have to deduct cost of that land. So cost you have already given. Cost is 2 million. So after deducting that cost of 2 million from the realization value, you will receive 2 million. That is the business gain. So that business gain should be taxable. If we are unfair if we use this total compensation value as the realization, then what will happen? Then what will be the business gain? 12 million minus 2 million, that is 14 million minus 2 million, that is 12 million will be the business gain. But we do not consider, we do not calculate the business or a gain or a loss like that. We have specific provision to calculate involuntary realized assets consideration value. So we use it net cost plus excess of compensation, 2 million plus 2 million, 4 million. From that realization value we can deduct cost, that is 2 million. Then the business gain is 2 million. That 2 million should be added to the gain, business gain. Then the cost of the land. This land is not applicable for the depreciation because since this land is the cost of the new land, we consider the cost as the value we have. So that means, we even though we purchase this one, we consider this 2 million cost of the new land, that is 2 million, no capital allowances for lands. So we can move to the building. For the building consideration, same amount should be considered. Net cost plus excess of compensation. So net cost is 6 million. Excess of compensation. So we received compensation only 5 million, but we replaced asset by paying 8 million. That means no excess is there. If there is an excess, that excess can be considered the building value. But here no excess, therefore only the 6 million is the realization value. From that realization value we can deduct cost. After deducting cost, there is no profit, no loss situation, no gain, no loss. Then we can move to the cost of new building. So cost of that building is 6 million. Then the expenditure we incurred, additional excess expenditure we incurred for the acquisition, replacement, that is 3 million. For the land, we paid lesser value. Therefore, we can consider only the 2 million, because 2 million plus the excess of cost. Here excess of cost means 5 million minus 8 million, that is 3 million. If we have cost exceeds the compensation, then the land value will be that cost plus that excess amount. But here we don't have excess amount, therefore cost of that new land is 2 million. For the cost of the new building will be the cost plus the additional expenditure incurred to purchase new asset, that is 3 million. So 6 million plus 3 million, that is 9 million. To that million, this person can deduct capital allowances because it is a depreciable asset. So this is how we have to calculate gain or a loss in respect of the realization. Yes, actually this is the last week document. Last week I did not share this document. So this is, I think, not 5 but 6. So this is the 5 or 6. I think this is 6. So this is the last week one. So this with Miss Kalhari. So she will share or she will upload it to the Google Drive. So she will ask her. She will do it. So I have already shared, but I have done it few hours before. So this is how we have to do this calculation. So I wanted to explain it. Then we can move to the new slides, new sets of slides, because I have already explained all other slides. Okay. So if you have some issues about involuntary realization, you can ask. Okay. This is no sets of 7 sets of slides. This is number 7. So number 5 is for investment income. I have already shared it with you. Then last week we did gains on realization of assets and liabilities. That is 6. Now this is taxable income, number 7. So this is the last sets of the calculation. Actual calculations means in my first presentation I explained about the charging provision. So charging provision is the most important section in that. It says from whom, when, how we are going to tax. We are going to collect, calculate income tax. So it says income tax shall be payable for each year of assessment. So we are considering year of assessment. Who should do it? By a person. So person includes individuals and entities. Entities means companies, all other organizations. But they should have taxable income or a final withholding payment. So in my next sets of slides, I will explain what are the final withholding payments. So our target was to consider to calculate the taxable income, up to taxable income. So now we are moving to that taxable income. So person means individual and entity. I think you can remember everything. This is just a reminder. Then for the taxable income, we have a specific definition under section 3. It says taxable income of the act to comprise 4 heads of charge, namely Assessable income from employment, business, investment and other income. So for other income sources, we don't have much provisions to explain. That is why I did not explain it, because all income we are receiving can be categorized under employment, business or investment. So after calculating employment income, we will calculate assessable income from business. So you can remember all these things. Income from income sources 5 to 8, we discussed about income sources, employment, business, investment and other income sources. Then we deducted some expenditure under section 10, 11, then section 12 to 19 under specific deduction rules. But I said that we cannot deduct any deductions, any expenditure when we are calculating employment income. That means the total amount we are receiving from employment should be taxed without doing any deductions of expenditure. So after deducting these expenditure for investment and business income source, we will have assessable income. That is under section 4. After that, we are receiving taxable income. So to be calculated that taxable income, in arriving at that taxable income, we can do some deductions. There are some deductions that we can allow, that we can deduct. There are some, those are expenditure, but we are talking them as qualifying payments and reliefs. That means not all are not the payments, all are not expenditure, but reliefs also there. So for the deduction of these reliefs and qualifying payments, specific provision is provided in the Act, that is section 52. So under section 52, we are entitled to deduct some reliefs and qualifying payments. So section 52 explains, to all taxpayers, qualifying payments listed in the 5th schedule are deductible when calculating taxable income. So that means after we are calculating assessable income, we can deduct reliefs and qualifying payments to be calculated the taxable income. So what is the difference between assessable income and taxable income? That is reliefs and qualifying payments. So reliefs and qualifying payments deductions cannot be done as it is. There are a lot of limitations. There are a lot of conditions. There are a lot of rules. So that rules and conditions are provided under section 52 and schedule 5, 5th schedule. So you should read section 52 and 5th schedule very carefully to get better understanding about these reliefs and qualifying payments. So when we are calculating assessable income and when we are identifying persons, I explained non-residents, non-citizens, like that. So without considering whether that taxpayers are, that persons are residents, non-residents, to all taxpayers we can allow for the deduction of qualifying payments. To all taxpayers, qualifying payments listed in 5th schedule are deductible. But when we are deducting reliefs, it is not entitled to all taxpayers. Only resident individuals are entitled to deduct reliefs. All reliefs can be deducted when calculating a resident individual's tax liability. So here we discuss, here I have mentioned taxpayers, all persons, but here it is for individuals, not all individuals but resident individuals. That means all reliefs are entitled to be deducted by the resident individuals. But only for non-resident Sri Lankan citizens are eligible to deduct personal relief. So I will explain what are the qualifying payments and what are the reliefs and what are the personal reliefs. So when we are deducting qualifying payments, all taxpayers, all persons can be deducted it. But when we are deducting reliefs, resident individuals are entitled to deduct all reliefs. Non-resident Sri Lankan citizens are entitled to deduct only personal relief. That means you can understand there are a lot of reliefs. Among that relief, only personal relief is deductible when we are calculating non-resident Sri Lankan citizens tax liability. So if it is non-resident, non-citizen, that means reliefs are not available, not deductible. Resident individuals are entitled to deduct all reliefs. Non-resident citizens are entitled to deduct personal relief. Non-resident non-citizens are not entitled to deduct any relief. So after deducting reliefs, after calculating the assessable income, we can deduct qualifying payments and reliefs. Then we will have a taxable income. To that taxable income, we can apply tax rates. Then we can calculate tax liability of that taxpayer. So what are the qualifying payments? What are the qualifying payments? So what are the qualifying payments that we can deduct? Donations in money to approved charitable institutions. So that is one of the qualifying payment. Deductions, donations in money to approved charitable institutions. So why do we have this kind of qualifying payments? Why we didn't deduct these donations when we are calculating the assessable income? When we are calculating the assessable income also, we allowed to deduct some expenditure. So why we didn't allow donations when we are calculating the assessable income? Who can tell me the reason? Who can tell me the reason? We did not allow donations in calculating the assessable income. What is the reason? What is the reason? What kind of expenditure we deducted under section 11, 12 up to 19? What kind of expenses we entitled to deduct? What kind of expenditure? Expenditure incurred in the production of income. Expenditure incurred in the production of income. We allow to deduct salaries. Why? We incurred expenditure for salaries in the production of income. We deducted electricity, telephone, machine, depreciation, all that kind of expenditure we incurred in the production of income. If it is a donation, do we need to make that expenditure in the production of income? No. We donate we make the donations from the income we earn. That means from the income we earn, we make donations. Not to earn income we are making the donation, but from the income we incurred, we make that donation. That is why we do not allow this kind of donations when we are calculating assessable income. But in the common world, in the normal world, we have to pay this kind of donations, we have to incur this kind of donations. So it is a must for the civilized society. That is why this kind of donations are entitled to be deducted, but not when we are calculating the assessable income, but after calculating the assessable income, in arriving at the taxable income, we can deduct donations. So we have given specific place to deduct income incurred not in respect of the production of income. That is one of the expenditure is donation. So first type of donation. So you can see several types of donations and some expenditure incurred. So we have two types of donations. Donation one is in money to approved charitable institution. So to be considered some donations as a qualifying payment, very important specifications, rules, conditions are there. First one is it should be a approved charitable institution. If we are donating some money to an approved charitable institution in money, not in kind, not in goods, but in money, then that amount can be considered as a qualifying payment, but limitations are there. Not the total donated amount, but some conditions are there. I will explain it later. So, to a charitable institution providing care for the sick or needy. So what kind of charitable institutions are considered as approved charitable institution? There are a lot of charitable institutions, but if we have made that donation to an approved charitable institution, then only we can consider that payment as a qualifying payment. It should be a not just charitable institution, but the approved charitable institution. To be obtained that approval, that charitable institution should provide care for the sick or needy. And very recently we have introduced new institution. We call it an institution incorporated or registered under any law in force for the registration of school service organizations, social service organizations that provide health care facilities in collaboration with healthcare or education services of the government. So if we have donated that to that kind of institution, that is also considered as a charitable institution. But that two types of charitable institutions should be approved by the minister. There may be lot of charitable institutions providing this kind of care for sick or needy or health care or educational services of the government, but that institution should be approved by the minister by declaring a gazette, by specifying in a gazette. Then only we can consider it as an approved charitable institution. Then we can consider that donation for the qualifying payment, but the deduction will be allowed with these limitations. So if that donation is made by an individual to this kind of charitable institution, not total donated amount is allowable as a deduction, but 1/3 of the taxable income or 75,000 or the value donated, whichever is less will be considered as a donation. For an example, if an individual, suppose Mr. Pereira, if Mr. Pereira donated 100,000 rupees, because it should be in money, 100,000 rupees to a approved charitable institution, he is not entitled to deduct that total 100,000. He has to compare that 100,000 donation with the taxable income of that person's business and the 75,000. After comparing that donated amount with 1/3 of taxable income of 75,000, after considering that, comparing that two figures, he can deduct the lesser amount as a donation, as a qualifying payment. If that donator, if that person is an entity, for an example, a company, then 1/5 of the taxable income of 500,000, whichever is less, can be deducted. So if the donated value is lesser than these two amounts, then the donated amount should be deducted. So I think now you can understand, for the deduction of qualifying payments, two conditions are there. It should be an approved charitable institution, approved by the minister. Then the donated amount should be limited to 1/3 of the taxable income of 75,000 or 1/5 of the taxable income of 500,000, whichever is less. Then the second donation type is donations to the government. If that donation is made to the government, the total amount is allowable as a deduction, but there is no limitation for the donated amount or a donator. Either it can be in money or in kind. Donations in money or otherwise to the government are also qualifying. Donations are deductible, are qualifying. Donations are deductible with no limitation but cannot be carried forward. So this kind of things cannot be carried forward, only they can deduct that amount in the same year. So no limitations for the donations made to the government. Government means government schools, government hospitals, government department, government ministries, any government organization. But not to the authorities, boards, statutory bodies. Those are that kind of institutions are not considered as the government. Then contribution for shops for female Samurdhi beneficiaries in money or otherwise. To establish a shop for a female from a Samurdhi beneficiary family. So if I am an individual or company, I can contribute for shops for female Samurdhi beneficiary. That means to establish a shop for a female from a Samurdhi beneficiary family. That means there are a lot of Samurdhi beneficiary families. If there is a lady in that Samurdhi beneficiary family, female, and if that female wants to open up a shop in some area, and if any person wish to contribute to establish that shop, that amount is considered as a qualifying payment. So the main requirement is it must be recommended and confirmed by the Department of Samurdhi Development, because otherwise we don't know whether that female is a beneficiary from the Samurdhi beneficiary family. Therefore, that confirmation is required. If any person can donate to that kind of email, that contribution is considered as a qualifying payment. The next qualifying payment was provided to encourage film industry, film production and cinema construction or upgrade. So that qualifying payment is little bit different. So it was given to encourage film industry, film production or a construction or upgrading of cinema. Eligible expenditures for film production cost of not less than rupees 5 million, including promotional cost. That means for the film production, not less than rupees 5 million should be incurred. For new cinema construction, up to Sri Lankan rupees 25 million, or for cinema upgradation, cost up to rupees 10 million. These are the eligible expenditure criteria. So deduction limits are provided here. Deduction limit is 1/3 of taxable income for the year. Then the balance can be carried forward to be deducted in the next year. So that is that expenditure can be carried forward after deducting 1/3 of taxable income from the expenditure incurred year. So those are the qualifying payments available in the Act under Schedule 5. Then we can move to the relief. There are several types of reliefs. First relief and first important relief is personal relief. We call it personal relief. So for the year of assessment 24-25, personal relief was 1.2 million. So I think you can remember, reliefs are entitled only to individuals, not to persons. Persons means it is not entitled to the companies. But qualifying payments are entitled to person, that means to individual and entities. But reliefs are entitled only to individuals. So personal relief for year of assessment 24-25 was 1.2 million per year of assessment. Per month it was 100,000, but we do not apportion that 12 lakhs, that means 1.2 million for the deduction. Total amount, even though that person served for 1 day per year of assessment, for that 1 day also we will allow 1.2 million without considering how many months, how many days he was engaging in the business or employment. Without considering that, 1.2 million or 1.8 million total amount is deductible. I think you can understand what I am explaining. That means irrespective of whether they were in business or investment industry or employment, total amount is allowable as a deduction per year of assessment. So for the year of assessment 25-26, that personal relief is 1.8 million. So to all resident individuals and citizens in Sri Lanka are entitled to deduct personal relief. But an individual acting as a trustee, receiver, executor, liquidator cannot claim personal relief in that capacity. That means as a trustee he cannot deduct personal relief, and personal relief cannot be applied against capital gain. That means capital gain is a part of the investment asset. So after we are calculating assessable income from employment, business and investment, including the capital gain, consider it as total investment, total assessable income. So we are deducting relief from the total assessable income, but when we are deducting personal relief, we have to disregard capital gains if available in within that investment income, because capital gains, against that capital gain we cannot deduct personal relief. When we are doing some examples, you can understand it very clearly. So the next relief is rent relief. So what is the rent relief? Rent relief means if we are having a rent income, then we can deduct relief. So I think you can remember when I am explaining about the difference between investment and business income, I explained that under one person, that rent income can be a business income, business source, and in the hands of the other person, that income may be categorized under investment income. So how do we categorize them? How do we distinguish that rent income for investment and business? If a person is engaging in the business of renting premises, that person receives rent income, but we consider that rent income as a business income. Some people, some persons has asset held as investment. That means that person, some person has, some individuals has more than one house. So he can rent one house because he has more than one house, therefore he can rent one. Then that is not for the business, but it is an investment income. So rent income can be considered in two different ways in the hands of two different person. If one person is engaging in business, and if he is engaging in letting business premises, letting premises for accommodation, then that income should be categorized under business income. So rent relief is not entitled to the deduction from that kind of business income. So if we are having rent income from an investment asset, then only we can deduct this qualified 25% of rent relief. So you should consider several specifications, several conditions are there to be deducted rent relief. The first one is, even though that is a rent income, we have to determine whether that rent income should be categorized under business income or investment income. If we can categorize that rent income under business income, then we cannot deduct rent relief. If we can categorize that rent income under investment income, then only rent relief is entitled to be deducted. Here it says, an individual earning rental income from an investment asset. So you know what are the types of assets. So if we are using some business asset, depreciable asset, and if we are receiving income from that depreciable asset or business asset, we call it business income from business. So if we are receiving some income from holding an asset, we call it investment asset. For an example, rent income, interest income, dividend income, all are receiving because of the holding of that asset. So we call that kind of assets an investment asset. So if we are having rent income from that kind of investment asset, then only we can deduct rent relief. Rent relief is 25%. we are allowing this kind of 25% is because the investment asset owner cannot deduct depreciation. He cannot deduct depreciation. So not only for the depreciation, for repair, maintenance and depreciation, we are giving this 25% relief. So sometimes repair, maintenance and depreciation, if we calculate repair or maintenance expenditure is higher than the 25%, then they can deduct actual amount. That means if we are having an investment asset and if we are receiving rent income from that investment asset, either we can deduct 25% of the gross rental income or repair or maintenance expenditure actually incurred. Normally depreciation is not allowable for the investment asset, therefore it is not deductible. But for the expenditure we incurred for repair and maintenance, actual expenditure can be deducted, or not the end, you can deduct 25% of the total rental income or repair or maintenance actual expenditure. So one situation can be considered, both cannot be deducted. Then the solar relief, that is the next relief available for the deduction, that is solar relief, applies to resident individuals. So this is also applicable to resident individuals. So reliefs are entitled for the individuals, but rent and solar relief is applicable only for resident individual. Personal relief is allowable for resident and citizens. So solar relief can be deducted, applies to resident individuals who have installed solar panels connected to the national grid. That means if I am the owner of this house and if I have fixed solar panel in my roof, so that investment amount can be deducted as a relief. Per year, upper value is 600,000. If we have incurred more than 600,000 to install solar panels in my house, and if that solar installation is connected to the national grid, then I can deduct 600,000 per year. If I have incurred 1.2 million, I can deduct 600,000 in this year, and the next year the balance 600,000 can be deducted. So this 600,000 is entitled to be deducted on the invested amount. So not only the invested amount, if we have obtained a loan for the acquisition of installation of the solar panel prior to April 1st, 2024, and if we are paying interest now, that interest or other installment, that installment amount and the interest amount can be deducted under the solar panel relief. So for the deduction of this 600,000, solar panel installation should be done after 1st of April 2021 if we installed it using cash. That means it is involved in money, then it should be after 1st of April 2021. That means that investment should be made after 1st of April 2021. But if we have obtained a loan for the fixing of the solar panel in the roof of my house, if I am still paying the installment and the interest, even though I obtained that loan prior to 1st of April 2021, if we are still making the payment, capital payment and the interest part, for that amount we can claim solar relief. Okay, if you have questions, now you can ask. If you have questions, you can ask. ප්‍රශ්න නැද්ද? If you have questions, you can ask. Silence means no questions. I don't know whether you understood or not, because no response from any student. තේරුණාද නැද්ද? තේරුණ නැති හින්දා අහන්න නැද්ද? තේරුණා වැඩි හින්දා අහන්න නැද්ද? I don't know. If you have questions, you can ask, because when you are doing your final examination, you should know these things. All qualifying payments and reliefs should be applied for the final calculation. So if you have questions, you can ask. Now we can move to the tax rates. So these are the applicable tax rates. So after calculating taxable income, what we have to do? We have to apply relevant income tax rates to that taxable income. So what are the tax rates applicable? You are not audible enough, is it? Is it okay now? Can you hear me now? Hello, is it okay? Okay. So these are the applicable income tax rates. So these rates are applicable for individuals. So we call these rates progressive income tax rates. So why do we use that word? Progressive rate. Progressive rate means not to all taxable income we are going to apply one rate. For the taxable income, we have several slabs. That means for one slab we have one rate. After including more taxable income to that first amount, the applicable rate will be high. So for first 1 million, so this is taxable income. That means after we are calculating assessable income, from that assessable income we can deduct qualifying payments and reliefs. Reliefs means at least we can deduct personal relief, that is 1.8 million. So you can understand, if our assessable income exceeds 1.8 million, then only we have a taxable income. Taxable income cannot be a minus figure. Definitely it should be a plus figure or 0. It cannot be a minus figure. So after calculating the taxable income, for first 1 million we can apply 6% rate. For the next 500,000, applicable tax rate is 18%. For an example, if our taxable income is 2 million, out of that 2 million, for first 1 million we have to apply 6%. For the balance 5% we can apply 500,000 we can apply 18%. For the balance 500,000 we can apply 24%. That means we have progressive tax rates when our income rising, so tax rates also same. So we have several tax rates, progressive tax rates 6%, 18%, 12%, 24%, 30% and 36%. So for the balance we have to apply 36%. 1 million, 2 million, 2.5 million, up to 2.5 million we have several tax rates. The excessive amount of 2.5 million should be applied 36 income tax rate. So for other parts, if that individual has a terminal benefit means if that person receives some compensation for loss of office, so pension, gratuities, likewise. So I explained those income when we are calculating assessable income from employment. For that kind of terminal benefits, we can apply for first 10 million 0, for the next 10 million 6%, for the balance 12%. For the capital gain from 25 to 26 it is 15%. So 25 to 26 means from the certified day of this act, that is 15 million. For the liquor and tobacco business, that is 45 million. For the profit from service exports and foreign sources, that is 15 million maximum rate is applicable. Prior to 20% it was exempted, but now it is 15%. For the partnership taxation, if it is a partnership, so we have to calculate partnership taxable income the same way we have calculated for individuals and companies, because I will do separately the partnership calculation. So most of the provisions are very similar to the calculation. So for the for the partnership, normally we have to apply income tax rates. For the first 1 million, no tax, 0%. For the balance taxable income, that is 6%. So 6% is the maximum amount. Then for the capital gain, applicable tax rate is 15% for the partnership. For the corporate, for the companies, normal applicable tax rate is 30%. For the capital gain also 30%. Liquor and tobacco, manufacturing, betting and gaming businesses 45%. For the liquor tobacco products, if they are exporting, normal tax rate is applicable. Then gains from the service exporters, maximum rate is 15%. So all other entities, if it is trust, NGO, unit trust, applicable rate is 30%. If it is a capital gain, applicable rate is a 30%. For the charitable institution, applicable rates are 14% and for capital gain 10%. So NGOs applicable rate is 30%. So then we can consider the tax credits. So I will explain that tax credits in detail when we are doing the next sets of slides, that is methods of payments. So but prior to the application of some essay payment, self-assessment payment, famous. Some tax credits can be deducted. So tax credit means after applying relevant income tax rates to be calculated the payable tax, we can deduct some tax credits. Tax credits means taxes already deducted from our income. It can be from EPIT, from withholding tax, or under AIT. So after deducting that type of tax credits, we will have balance tax payable. So we have done our mid-examination. For that examination, we did only up to assessable income. So after that, after calculating the assessable income, we have to deduct qualifying payments and reliefs. Then we will have taxable income. We have to apply relevant tax rates for that taxable income. Then we have tax payable amount. From that tax payable amount, we can deduct tax credits. Then we will have balance tax payable or refund amount. So after this, here I have mentioned some tax exemptions available from 2025 April 1st. That means applicable for the taxable year of assessment that you are going to do for your final examination. So these are the exemptions available for this period. So I have already explained these tax exemptions, but it is better if you can go through these slides, go through this list, then you can easily keep these exemptions in your mind. So some exemptions are relevant for employment income. So these are institutional exemptions. Institutional exemptions means as an institution, all income received by that institution are tax exempt. So these are the exemptions. For an example, universities, central bank, government departments, authorities are not allowable, not applicable. Government, Sri Lanka or local authority. Then exemptions applicable for employment income. Then exemption applicable for capital gain. Then exemptions applicable for interest income. Exemptions applicable for other. So these exemptions are available. In addition to that, exemptions applicable for dividend income. So you have to read this document. You have to read this document because these exemptions are very important. So up to your mid-examination, we did up to business income for your business mid-examination. We did up to business income. So investment income part is here. Then we will for the final examination, I will include investment income as well. So then you should know what are the investment income that are exempt from income tax. So these are the income that are exempt from income tax. So read this list of exemptions carefully. And in addition to that, in the third schedule of the Act, Consolidated Act, you can read these things. And in the amendment of 2026, number 11 of 2026, you can read new additions to the Consolidated Act. So that one also should be read. Okay. So we can move to the next set of slides. Until then, I think you need a break. So do you need a break? It is okay. You will have a break. We will start by 8:30 because I want to change the slides. So you will have have a break for 10 to 15 minutes. Okay, we can start. So our next set of slides is methods and time for payment. So what is the meaning of methods and time for payment? That means after we are calculating, we have to pay taxes. After we are calculating our tax liability, we have to pay taxes. So when we are making taxes, how to pay it? How to pay it? When we have to pay it? So that is the question we have. So we have to identify the time for payment and the method for that payment to be made to the department. So several situations are there. Several situations are there, as I already explained. So there are 3 methods to make the payment. Tax liability, after we are calculating the tax liability, we have to make that payment to the department. So we have 3 methods to make that payment to the department. First one is withholding. Under withholding, we can make the tax payment. The second one is installment under division 3. Third one is assessment under division 4. So these are the 3 methods we have to make payment to the department. So what is the meaning of making withholding? So as I have already explained in my first session, withholding is not a specific taxation, specific type of tax, but it is one of the methods of making income tax payment to the department. So that is why I said at the very beginning that withholding tax is not a tax. APIT is not a tax. AIT is not a tax, but it is a method of payment of income tax. So we call it withholding tax. It is type of withholding tax. So what is the meaning of withholding tax? Withholding means when some person making the payment to another one, the payee, person who makes that payment, withhold some amount with him, and balance amount should be paid to the person who owns that income, and the deducted amount, we call it withholding tax. That withholding tax should be paid to the department. So after making that withholding tax to the department, after we are calculating our tax liability here, we can deduct that withhold amount as a tax credit. For an example, when we are receiving interest income, it is a part of the income source. That means it is part of the interest income is a part of the investment income source. Or if we are receiving employment income, wages and everything, that is a part of the employment income. So once we are receiving employment income without doing any deductions, it is a part of the assessable income. Then qualifying payments or reliefs, if available, can be deducted. Then we will have taxable income. So this taxable income includes that employment income. We have very beginning we have considered it. So after applying relevant tax rates, we will calculate the liability. Then against this tax liability, we can deduct APIT deducted by the employer from my employment income. That is a type of tax credit. So when we are receiving employment income, our employer deduct APIT, advanced personal income tax. It is similar to payee, pay as you earn. So after deducting that amount, that deducted amount should be paid to the department by that employer. So the person who receives that income, that means employee, should submit this return. In his return, he should mention what is the income he received, not the net income but the gross income. After mentioning that gross income, tax liability in respect of the gross employment income should be calculated, and the deducted amount by that employer can be mentioned under tax credit. That means we have already paid income tax for my employment income when I am receiving salaries and employment income from my employer. Therefore, I can deduct it as a tax credit. Likewise, if I have an interest income, so that interest income should be a part of the investment income here, income and income source. Then if there are some deductions we can deduct, then it is part of the assessable income. Then we can deduct qualifying payments and relief. If there is a still taxable income balance, to that taxable income we have to apply normal tax rates to be calculated tax liability. After that, when I am receiving interest from the bank, that bank should deduct withholding tax on that interest income. Now that is 10%. That 10% can be deducted from here as a tax credit. Then I will have balance tax payable. If my tax credits are higher than my tax liability, it will be a refund. So this is the way we are deducting tax payments. So we can deduct that kind of tax payments if we have already deducted it under withholding tax method. So now we have several types of withholding taxes. In the Act, you can see, in the Principal Act, you can see withholding tax by employers under Section 83. Then under Section 84, you can see withholding tax on investment returns. Under Section 85, you can see withholding tax on service fees and contract payments. So very beginning, when we are introducing Principal Act, these deductions were compulsory. Without asking consent from the recipient, the withholding agent, the person who pays that amount to the recipient, should deduct withholding tax. So after that, from 1st of January 2020, this type of withholding system was abolished, removed. Then we had several issues because this withholding tax method is the lower cost tax calculation method. Without paying any collection cost, tax can be deducted through the method of withholding, because without any effort, income payer deduct tax on behalf of the government and they remit it to the Inland Revenue Department. But unfortunately, in 1st of January 2020, these withholding methods were abolished. But after that, government identified the importance of this withholding method. Therefore, again, from 1st of April 2020, this withholding method was reintroduced. When reintroducing that withholding method, the names applied for that withholding was removed and renamed. So, under Section 83, we had withholding tax by employers. We changed that name to Advanced Personal Income Tax and introduced a new section, that is 83A, because we closed Section 83 on 1st of January 2020. Again reintroduced that kind of withholding method system. So Therefore, new section was introduced, that is 83A. That is for the employment income deduction. We call it advanced personal income tax, APIT. Then for the investment returns also we had the specific section, that is 84. After removing it from 1st of January 2020, reintroduced it again from 1st of April 2020. So the name was changed to advance income tax. So it is not withholding tax on investment returns, it is advance income tax. So new section was introduced, that is 84A, to deduct investment returns. Investment returns means interest, dividend, rent, everything investment income. If there are some applicable income withholding tax rates, then we call it advance income tax. Then under section 85 we had withholding tax on service fees, but it was abolished, it was removed, but it was not introduced in the same day. The same day means on 1st of April 2020, that service fee withholding was not introduced, but from 1st of January 2023 it was reintroduced. So now we have withholding tax on service fee under section 85A. So these are the changes made to withholding taxes. So now you know what is the meaning of withholding tax, and it is not a part of the type of the tax, it is a method of payment. So when we are deducting withholding taxes, we have very specific rules. Specific rules means withholding tax, advanced personal tax. About advanced personal tax I have already explained when we are studying for employment income. So now I am not going to explain it again. Today we are starting from the employment advanced income tax. So advanced income tax should be deducted by a person, and that person should deduct withholding tax when makes a payment to resident or non-resident person. So this is the theory. So in the person, if we are referring the definition for person, it does not include government, ministries, departments and local authorities. That means if that person is a government, if that government institution makes payments to resident or non-resident, it is not necessary to deduct advance income tax. I am not talking about the APIT, but advance income tax. So we had some issues. When we are making that kind of payments by the government to a non-resident person. So non-resident persons means they may not in Sri Lanka always. So sometimes if they are working in Sri Lanka for very few days, and after collecting some money, some amount, some income from the government, they are going back to their country. If we are having that kind of situations, we lose lot of income tax, because prior to the deduction or prior to the collection of income tax from that kind of taxpayers, non-residents, they may leave country. Therefore, we are applying withholding tax for income tax purposes for mainly to non-resident persons. So if a government makes a payment to non-resident person, according to the available provision at that time, that government couldn't deduct withholding tax on that non-resident person, because in the act it says person does not include government. Therefore, 1st of January 2023, with effect from 1st of January 2023, we have included some parts to the definition of the person. So for the purpose of subsection 1A, so it is subsection 1A is this one. A person includes the government of Sri Lanka in the case of a payment made to a non-resident person other than a payment derived through a Sri Lankan permanent establishment. So what we have done was, we couldn't deduct withholding tax AIT when we are making payment to non-resident person by the government. Therefore, we included this provision to section 84 and 85, section 84A, saying that for the purpose of deduction of withholding tax, person includes the government. Therefore, now if we are making payment by a government institution to a non-resident person, now that government can deduct withholding tax. So if when we are identifying some loose points in the act, loopholes in the act, we will insert amendments, we will change sections, we will substitute, we will remove to the provisions of the act. So this is one of the inclusion we made to the act, to be considered the government as a person. But when we are making advance, when we are deducting advance income tax, these kind of situations are not subject to withholding tax. That means when a person making a payment, person, withholding tax should be deducted, but some limitations are there. If that payment is made by a person under these situations, that is not subject to withholding tax. For an example, if there is an individual who is not doing business, that means that person is like us, like me. I am not doing a business, I am just having employment income. Like you also are working in some institution, you are not doing business. If you are in rented house, if you are making payment to another person, you cannot deduct advance income tax. Because why? Individual not doing business is not subject to withholding tax. If I am not doing a business, if I am making payment to another person under investment return, I cannot deduct withholding tax. That is why a layman cannot deduct withholding tax from the payment when they are making to resident or non-resident person. If I am rented out a building for my residential purpose, I am not doing a business. So when I am paying rent income person, I cannot deduct withholding tax. But if I am engaging in a business and in that premises, the premises is rented out one. So when I am making the rent payment to the tenant, from that amount I have to deduct 10% as a withholding agent. So if I am not doing a business, I cannot be a withholding agent. If I am not doing a business, if I am doing a business, I am considered as a agent. Then person pays interest on ordinary loans. If a person pays interest on ordinary loans to financial institution, that means person means you, me, or a company. It can be either a company. If I have obtained a loan from a financial institution, and when I am making the interest payment on that ordinary loan, I cannot deduct withholding tax. But if I obtain a loan from other than, not practical. So if I borrowed a loan from a financial institution under ordinary loan scheme, when I am making the payment of interest to that financial institution, I cannot deduct withholding tax. That is the Next condition. The third one is a person pays interest on treasury bills and bonds. If a person pays interest on treasury bills and treasury bonds to resident on, but you should keep in your mind this, even though this is not subject to withholding tax, that means interest on treasury bills and treasury bonds, it is subject to income tax. Therefore, even though withholding taxes are not deducting from the interest on treasury bills and treasury bonds, if we are receiving interest on treasury bills and treasury bonds, I have to apply tax rates and I have to calculate tax liability on that interest. It is subject to tax, income tax, but it is not subject to withholding tax. The next one is a person makes a payment to another person, but in the hands of the other person, that income is tax exempt under some provisions in the Act. For an example, I am receiving an interest from a financial institution for my foreign currency account. So I have a foreign currency account, I am receiving interest income. But in my hand, it is not taxable, it is tax exempt. If my income is tax exempt, what is the purpose of deducting withholding tax on that amount? Because if it is tax exempt, there will be no tax liability arise on that income. Suppose I have only one income, interest income, it is from the foreign currency account. So I have only one at that interest income. So deductions are available. Then assessable, it is not a part of the assessable income. It is not a part of the sources of income because it is an exempt amount. It is exempt, therefore it is not a part of the income source. If it is not a part of the income source, we cannot grant credit. It is not necessary to grant credit because it is not taxable. If it is not taxable, it is not necessary to deduct withholding tax. That is why if we are receiving exempt income, for that exempt income, withholding deduction is not necessary. So in addition to that, in the 2026 amendment, one more important thing is included. It says commencing on or after April 1st, 2025. That means this is a period. If we are receiving interest income less than my taxable income, then also it is not necessary to deduct AIT. Because we have a specific rule given to the taxpayers. If the taxpayers' taxable income for the year is 0, then that person can give a self-declaration to the financial institution requesting not to deduct withholding tax. If a bank or financial institution receives this kind of direction, self-direction, it is not necessary to deduct withholding tax. Therefore, this new provision is inserted to the Principal Act under number 11 of 2026 Amendment Act. So these are the AIT rates applicable for taxpayers. If it is a sale of gem sold at an auction conducted by the National Gem and Jewellery Authority, withholding tax rate is 2.5%. That means if we are having a gold gem and if we are going to sell that gem at the auction conducted by the National Gem and Jewellery Authority, after selling, when we are receiving selling price from the National Gem and Jewellery Authority, they should deduct 2.5% of withholding tax and it should be paid to the department. So he should maintain proper records with regard to that deduction. He means National Gem and Jewellery Authority. The next one is interest or discount. It is not final. Final means it is progressive tax rates are applicable for interest and discount. So from 1st of April, deductible amount is 10%. So that means if we are receiving interest income from a bank, they should deduct 5% advance income tax on that interest. If we are receiving rent income, then if that payment exceeds 100,000 per month, on that amount 10% should be deducted. If that rent payments to non-residents, charge, natural resource payments, royalty or any other thing, the deductible interest rate to any non-resident person, deductible amount is 14%. So we are applying withholding tax method to non-residents, non-citizens, mainly non-resident non-citizens, because if they are not stay in Sri Lanka long period, since they are not staying in Sri Lanka for long period, sometimes we cannot collect taxes prior to their returning to their country. So therefore, considering that difficult situation of collecting taxes from them, withholding method is applied. So when we are paying any amount to a non-resident person, at that time we have to deduct withholding tax of 14%. For dividend, deductible amount is 15%. So these are the withholding tax rates. So you know withholding is not a tax, it is a method of collecting taxes. So under these rates, withholding tax should be deducted. But you know the rates applicable for individuals and corporates. So if even though these withholding taxes are deducted, their taxable rate, their applicable tax rates for individuals and companies are higher than these rates. Therefore, this is just a nominal value. After receiving this income, they have to apply normal income tax rates on the income they are receiving. So, after applying that rates, they can deduct this deducted amount as a credit. So now we are moving to the withholding tax on service fee and contract payments under section 85. So this is also similar to section 84. It says person should make a service fee to resident individual, or person pays service for an insurance payment to non-resident person. At that time they have to deduct withholding tax. But prior to the introduction of this new section with effect from 1st of January 2023, person was not included. The government was not included under the definition of under the purview of person. Therefore, we introduced this new amendment to the Act. According to that Act, that is the person includes, the government includes the person when they are making the payment to non-resident person, they have to deduct withholding tax. So this kind of situations are not subject to withholding tax. Individual not doing a business, then they cannot deduct withholding tax from service or contract payments. And if in the hands of the recipient that income is income tax exempt, then also the person who makes the payment cannot deduct withholding tax. Then how that person knows whether that is exempt or not? Specific details to the person who deducts tax. If he has a doubt, he can obtain a clearance from the Inland Revenue Department to consider whether that is exempt or not. So that clearance certificate is issued. So what are the type of income we are receiving under Section 85, and what are the income subject to withholding tax on service fees? If that is a service fee or an insurance premium with the source in Sri Lanka to a non-resident person, if that payment is made to a non-resident person and if that payment has a source in Sri Lanka, then only we can deduct 14% withholding tax. The next one is, if aggregate payment is more than 100,000 per month of a person who is providing this kind of services, then the payer should deduct 5% withholding tax. That means payment made per month should exceed 100,000. So to avoid paying taxes, taxpayers may request to pay their fee in several installments. We do not consider that. If the total amount exceeds 100 per month, at the time of completing that condition, the person should deduct for all payments made prior to that date from the payment that exceeds 100,000. So therefore no one can avoid taxes by making some arrangements. So teaching, lecturing, examining, invigilating or supervising an examination, so that is subject to withholding tax at the rate of 5%. Commission or brokerage to a resident insurance sales or canvassing agent. Services provided by an individual in the capacity of independent service provider. So you know who is the independent service provider, and the difference between independent service provider and an employee. I explained it in very beginning of our sessions. So if that person is an employee of that organization, this 5% should not be deducted, because then deduction is applicable under Section 83, that is under APIT, not under Section 85. Under Section 83, that is under APIT, 3A, under APIT. If that person is an independent service provider, means that person is doing a business. Therefore, the income should be categorized under business income. It is considered as an independent service provider, so such as doctor. So doctor can either be in the hospital as an employee and as a independent service provider. I gave an example when we are doing that part, so I think you can remember. So engineer, accountant, lawyer, software developer, researcher, academics. So that up to that point we had this section. After that, under section 11 of 2026 Amendment Act, we have included all other services. Then all these service providers are subject to withholding tax. But construction services, janitorial and security services, catering management services are not, no, we cannot say it like it now. Then payment to non-residents with respect to land, sea, air transport or telecommunication services, that is 2%. So these are the rates applicable for the deduction of withholding tax. Yes, there is a question. So if that person is a non-resident, non-citizen individual who is a foreign director of the company, normally directors of the company are considered as an employee of the organization. So it should be taxed under APIT, but in the APIT table, yes, APIT table 4. So it is not subject to withholding tax at 14%, but it is payment is made to non-resident employee. So these are the rates applicable to withholding tax. Then final withholding payment. So I think you can remember in the charging provision we had two categories. One is taxable income. So to that taxable income we had to apply income tax rates to be calculated tax liability. In addition to that, it mentioned withholding, final withholding. So what is the meaning of final withholding? Final withholding means if withholding tax rate is applied to a specific payment type, then that specific payment type is not subject to tax at the progressive tax rates. For an example, as I explained here, if it is an interest, that interest is a part of the income source, then it is a part of the assessable income and it is part of the taxable income. Then after applying tax liability and normal tax rates, tax credit can be granted. So for that interest income, withholding tax rate is 5%, but normal tax rates are not the 5%, but it can be 6%, 18%, 24%, 30% or 36%. That means it is taxable under progressive rates. So withholding tax rate is just a nominal value, since it is an interest. But if it is a final withholding payment, very beginning of the identification of that income source, we have to remove final withholding payments. Please refer section 5, 6, 7 and 8. In section 5, 6, 7 and 8, under subsection 2, it says the items that should be included, and item subsection 3 of each, that section 5, 6 or 7 said items that should be excluded. It says exempt amounts and final withholding payments should be excluded when we are identifying income sources. So if we are identifying employment income, from that employment income we have to remove final withholding payments and exempt amounts. When we are identifying business income, under subsection 3, we have to disregard exempt income from business and final withholding payments from business income. When we are identifying investment income, under subsection 3 of section 7, we have to disregard exempt amounts from investment income and final withholding payments from investment income, because for this part, to calculate the taxable income, we do not consider final withholding payments. We identify it separately, because for the final withholding payments, we cannot apply normal tax rates. It has a specific tax rate. Therefore, when we are identifying very beginning that tax types to the relevant sources, we remove final withholding payments. Therefore, it does not include income from sources, assessable income or a taxable income. Therefore, it is not a part of the tax liability, but it should be considered separately. So after removing that final withholding and exempt part from the identification of the sources, that final withholding payment should be considered to be taxed separately. So for that final withholding payment types, we have a specific tax rate. So parallel to this calculation of taxable income, we have to calculate withholding tax, final withholding tax. So deductions are not available. If we identified some income as final withholding payment, we can deduct withholding tax at the rate of final withholding payment, relevant rate for final withholding payment. Then it is not taxable at the normal tax rate. So that is the difference between taxable income and final withholding payment. So final withholding payment has specific tax rates, and final withholding payments are mentioned in the act. It says these are the income, these are the payment sources that we have to consider as final withholding payments. So if we are receiving a lottery, reward, betting or gambling income, when we are receiving it from the casino, they have to deduct withholding tax and they have to give my reward after deducting withholding tax. So it is not necessary to include that in that rewards under taxable income, but we have to consider it separately because it is a final withholding payment. So if that payment is made to a non-resident who is a non-citizen of Sri Lanka, non-resident, non-citizen, then also it is a final withholding payment. Non-resident, non-citizen means he is not staying in Sri Lanka for a long period, as well he is not a Sri Lankan. Therefore, deduction of tax is very difficult. So we don't know when they are coming to Sri Lanka, when they are returning Sri Lanka. So that is very difficult to collect taxes from them. That is why we have identified payments made to a non-resident who is not citizen of Sri Lanka as a final withholding payment. So it is not taxable at the normal progressive income tax rates, but it has a specific tax rate to be considered. So that is what I have mentioned here. Payments made to non-residents, this is the applicable tax rate. 14% should be deducted as a withholding tax. Then interest paid to treated as being derived by a non-resident but citizen. If that person is a non-resident but citizen, the total amount cannot be considered as a final withholding payment. Why? Because non-resident but citizens are entitled for the deduction of personal relief. So that is a right. That is a right of a taxpayer. Therefore, we have to allow them to deduct that personal relief. If we consider their total income as final withholding payment, then it is not a part of the income source, not a part of the assessable income, not a part of the taxable income. If it is not included in the assessable income or taxable income, deductions are not allowable as a credit. Therefore, up to that the personal relief, we considered it as a non-withholding payment. The amount exceeds that personal relief considered as a final withholding payment. The last one is dividends paid by a resident company. If that dividend is paid by a resident company, then it is tax exempt. Then we consider it as a final withholding payment. So these are the circulars we have already issued with regard to the withholding tax. So you can refer those things in the website of the Inland Revenue Department. So some exemptions are provided in that. So for withholding, that is exemption for withholding tax, not subject to withholding tax, all are available. If any person needs to collect a clearance certificate regarding the withholding tax, they can request it from the Inland Revenue Department, because normally all withholding agent means a person who deducts withholding tax from when they are making payment to others. So they know what are the items exempt from income tax. Therefore, it has already provided to them. they have any doubt, then only they can request a clarification from the IRD regarding the exemption. So these are the payment methods of withholding tax. So it should be paid to the department. So after deducting withholding tax by the withholding agent or the payer, he should issue a withholding tax certificate to the person who receives that income, because withholding agent is deducting that amount from on behalf of the recipient. So that is not withholding agent's money, that is withholdee's money. Therefore, withholdee should know what has done to the deducted amount. Therefore, he should submit a declaration, certificate of withholding tax deduction to the withholdee. So, per calendar year, it should be submitted. It should be covered a month and shall be served within 30 days after the end of the month. So, withholding certificate should be submitted once a month. So, there may be several deductions, but after including all deductions, once a month, withholding tax certificate should be issued by the withholding agent. It can be either soft copy or the hard copy. So after obtaining that certificate from the withholding agent, the details of the certificate should be included in the income tax return submitted by the payer. Then IRD can cross-check the deducted amount, whether that is paid to the department or not, and to be granted tax credit to the taxpayer. Therefore, deducted details are included in the deducted certificate. That detail should be included by the recipient. Therefore, it should be submitted to the recipient by the withholding agent. So after that, every withholding agent shall, within 30 days after the end of each year ending on 30th first day of March, an annual statement should be submitted. That means after deducting withholding taxes by the withholding agent, after 1 year, after March 31st is the last date of that year of assessment. So after that, before 30th of April, that withholding agent should submit a report to the department. We call it a return to the department. So, Commissioner General has already issued specifying procedures of withholding tax and the method of payment to the withholding agents. So, new rule was introduced to withholding agent who deducts AIT under the provisions of Section 18A shall file a quarterly investment statement as specified by the Commissioner General within 30 days after the end of each quarter. That means earlier they had to submit only one return once a year. But now they were advised to submit quarterly returns to the department. So quarterly returns should be submitted by the withholding agents mainly. So withholding agent is required to apply the currency exchange rate. So if it is a foreign currency, in foreign currency, published in the central bank website, which is relevant for the date of payment, to convert foreign currency amount into rupee amount for applicable cases. That means if we are making payment in foreign currency, that withholding tax should be deducted by applying current exchange selling rate. Current exchange rate, that means selling rate published by the Central Bank of Sri Lanka. Then if that investment is jointly owned by the withholdee with another person, relevant payment shall be apportioned among the joint owners in production to their interest in the investment. Where the interest of joint owners cannot be ascertained, they shall be treated as equal. That means sometimes we have joint accounts. We may have joint accounts. At that time, the total interest income should be apportioned according to that liability. So this is the withholding tax certificate. Then we can move to the set form. Our last payment method is installment payment. So prior to 2026 April 1st, we had this kind of calculation for installment payment. This kind of calculation means for the calculation of installment payment, we had to apply this formula. A is the current estimated tax payable. That means installment was calculated based on the estimated tax figures, not the actual figures, because we have to make payments under installment once the year of assessment starts. That means year of assessment starts from April 1st. In the same year, August 15th, we have to make our first installment. That means still we have not finished the year of assessment, still we have started the year of assessment, but first installment should be started from August 15th in the same year of assessment. So August 15th, November 15th, February 15th, May 15th, final payment is 30th of September. So those are the installment payments the taxpayer should make. So when they are making that payment, when they are calculating the amount to be paid as installment, we provided a specific method. We called it estimated method. So we called it statement of estimated tax payable. So statement should be provided with the calculation. So according to that statement, we had to make payment. So up to 25-26 year of assessment, we had set form for the calculation of installment. But after 2026 April 1st, this estimated method was removed. That means earlier we had to calculate installment payment on estimated basis, because it is just started from the year of assessment. No one knows what will happen at the end of the year of assessment. Therefore, according to this section, it should be calculated based on the estimated figures under section 90. So that was the method we had. So it is, so A minus C divided by B. A equals the current estimated tax payable for the year of assessment. So it was changed from section number 11 of 2026 Act. So according to that Act, A means not the estimated figure, but the payment may pay amount paid in the previous period. That means not the from 26 to 27 year of assessment, installment payment is calculating not based on the estimated figures, but the figures of immediately preceding year. That means if we are calculating 26-27 installment payment, it is not necessary to consider the estimated tax payable for the year of assessment 26-27, but the payment of tax, payable tax for the taxable income under the year of assessment 24-25. So that is how we have to calculate payable tax. So first of all, I will explain the method we applied prior to April 1st 2026. So A minus C divided by B. A means estimated tax payable. B means the number of installments. That means how many installments we have to pay. There are 4 installments. First one is in August, then February, then August, November, February and May. So we have 4 installments. We have to divide estimated tax payable minus tax paid as previous installment plus withholding tax. Then we have the estimated tax payable for the year of assessment. Then we have to divide it by 4. When we are calculating first installment payment, we have to divide it by 4. Then for the second tax period, it should be divided by 3. Then to calculate second one, it should be divided by 2. And for the calculation of final payable amount, it should be divided by 1. Likewise, we have to apply this formula to calculate the tax liability, to calculate installment payment. So these are the dates available for the installment payments: August 15th, November 15th, February 15th, May 15th, and the final payment should be made before 30th September. So statement of estimated tax payable was available at that time. That means when we are making the first payment in August 15th, we have to calculate, we have to submit this statement. It is a calculation of installment payment. So with this return, set form should be submitted to the return when we are making first payment to the department. So now it is not necessary to submit set form from 1st of April 2026 onwards, but we have to do the installment calculation based on the previous period tax liability. Based on that amount, we have to pay taxes to the department. So finally, after we are calculating our tax liability, that means after applying tax rates to taxable income, we have to fill a tax return. After filling that tax return, in that tax return we have lot of items. Next day I will show you the tax return for individuals, partnerships and companies. Then you can understand how we have to fill it. So after filling that tax return before 30th of November, it should be submitted to the department. So that return includes assessable income from each source, taxable income, gross tax payable, balance tax payable and all other information requested by the Commissioner General. So return should be accompanied with any other documents information specified by the Commissioner General. So in each and every return, it has mentioned what are the documents that should be submitted to the department. Mainly, if we are engaging in a business, audited statement of accounts are requesting by the company. So if it is a company, mainly audited accounts should be there. If it is a business of an individual, it is not a regulated formal tax computation may not be prepared, but they have to submit their tax return with the computation. So for the capital gain tax also we have a specific return, because once capital gain is once we are having some capital gain, at the same time we have to pay that amount to the department within 1 month period. We have to pay to the department. Therefore, specific return is available for capital gain tax. So these are the main things that I have to explain under methods of payments of taxes. So I have explained the 3 methods of payments. When we are doing our calculations for final examination, you should know how to calculate tax credits, because in your paper you have to calculate tax liability, then you have to deduct tax credits. I am not telling you the tax credits directly, but I will explain these are the income that person received, like that. So you should know you should have knowledge to categorize that withholding taxes into several sections. Then applicable rates are different, so that rates should be applied. Then you have to calculate applicable tax credits, then you can deduct that applicable tax credit from the total tax liability to be calculated the balance tax liability. So that is how we are doing our final examination. So it is not only for the individuals, companies and partnerships. You should know how to do the calculation. So next day we will do some calculations up to taxable income for individuals and company. Then we can start taxation for partnership. Then we can move to VAT and SSCL and international taxation. For international taxation, we are going to discuss only about the method of entering into a double tax treaty. So these are the things that we have to do. So if you have questions, you can ask. ප්‍රශ්න තියෙනවා නම් අහන්න. ප්‍රශ්න තියෙනවද